संजीव, हम स्टार्ट करते हैं। मेंबर्स
Yes,
विल
sir.
बी ज्वाइनिंग। तो लविश भी आ गया है
Start.
और
Yes, we are
प्रतिभा
live
भी।
on YouTube, sir.
सो प्रतिभा, यू कैन स्टार्ट द सेशन।
Okay. Okay. Warm welcome to everyone. I am CA Pratibha Singh Rathod, the moderator of this session, and आप सभी को मेरा एक बार फिर से प्यार भरा नमस्कार। आज आई थिंक बहुत इंपॉर्टेंट डे है बिकॉज जो डिसीजन 2024 होने वाला है लोकसभा इलेक्शन उसका फेज का एग्जीक्यूशन अब स्टार्ट हो चुका है एंड आई थिंक इन द कमिंग फ्यू डेज everyone will be exercising our constitutional right, the right to vote. So this election exercise, I think, will be the exercise of one of the largest democracies. So talking of India, its stature at the world level, or I would say the global level, is rising, and different countries, be it developed countries or the Western economies, are looking towards India to make their investments. And the latest update in this is that India has started its consultation. The Indian government has initiated its consultation with the Tesla representatives and the Indian industry because Elon Musk is here in India and he's proposing that he will unveil an investment worth of almost 2 to 3 billion in India. And I think in this respect, the online boot camp on international taxation is the much needed thing that was there. This boot camp was launched as a series of Gurukul series, a well thought of and a planned initiative under the leadership of CA Abhinav Agarwal ji, our chairman NIRC. Now, Gurukul की शिक्षा को शुरू करने से पहले, I want to welcome our dignitaries who are sharing the digital dais with me. I want to welcome CA Navya Malhotra ji, the Secretary of NIRC, the main linchpin who ensures that all the NIRC initiatives are executed in the most comprehensive manner. Talking of, we have with us CA Lavish Goyalji. I would welcome sir. Being the chairman, he's successfully leading the Patiala branch of NIRC. And I think now I would request all of us as a team that I want to welcome the guru of today's session, CA Nitin Naranji. So when I went through the profile of sir, it took me a little long because of the vast experience and the knowledge he is having. So talking of sir, he is a man with great intellect and knowledge, bringing with more than 21 years of experience in whatever subject you can think of, be it accounting, be it auditing, be it international taxation, transfer pricing, and whatnot. Talking of academically, he is a chartered accountant by profession and also hold a bachelorate degree of law as well as of commerce honors from Delhi University. Talking of his professional experience, he is currently working as a partner with Nangya Anderson India. And he has successfully worked as a director in Big Fours like PwC and EY. And I think everyone will agree with me that whosoever is working in Big Four always aspires that they reach that position someday. And we are glad that Sir is with us. Over all these years, he has successfully completed various TP assignments and has been very active in various national and international initiatives on TP. He's even a receiver of many awards like Outstanding Leaders Award 2022. Talking of his relation with ICI, he has been a keynote speaker in various seminars and webinars under ICI. And not only this, he has even contributed various articles and in various publications of ICI. So this is all about. If I missed anything, sir, I'm really sorry. But I tried that I cover all your profile, all your knowledge, and all your expertise. So now I welcome you to this dais and to share your insights. But before that, I would just request CA Navya Malhotra ji to share their insights with their wise words. Over to you, sir.
Thank you, Pratibha. Before commencing my words, I request Lavish to share his insights about today's session. Lavish.
Very good evening, sir. How are you, sir? Thank you. Thank you, first of all, Navya, sir, Pratibha, ma'am, and warm welcome to CA Nitin Naranji and everybody here to be with us and to have and I hope this 2 days prior sessions have been very enlightening for all of us, and I hope today is going to be along the same lines. I today, as you know, the whole world is a single marketplace at the moment, and due to this reason, the whole scenario has changed drastically. If we talk about, like, ever since the past 10-15 years, the whole economy is integrating throughout the world. And as a result, the importance of knowing these transfer pricing regulations have become even more imperative for everyone amongst us, because the slightest, because there's so many intricacies in these laws, that a slight lapse in these procedural elements can lead to huge loss, both to the government and to the nation and to the taxpayer as well. So this makes these sessions and constant upgradation and constant updation with the transfer pricing regulations and rules even more important. And I hope that all of us gathered here are going to learn a lot from this session today. And that's it. And once again, I would like to thank the team of NIRC, to be constantly updating the members and to be taking so many new initiatives. And especially for the young chartered accountants, for whom the knowledge of these tight grasp of these laws is very important, to grow their practice, and as well as, to guide our clients in a more meaningful manner. Thank you. Thank you once again.
Thank you, Lavish, and thank you, Pratibha. Before we actually start and commence with Nitinji, I would like to thank my chairman in absence, Abhinav Agarwal, for all his vision that he has laid down for the members and students. And in our endeavor to enhance the virtual series that started last year, we have created around 8 or 9 more series. And this is the fourth series that has been commenced for this year. And in the vision to include all, we have tried one of the branch executives, starting from the chairmans, to be in our moderating series, and a member out of all of us to be a coordinator and moderator for the series. This is a boot camp now renamed as Gurukul. Is a technical series where you will be gaining specialization, and I think it is the third day. And I must appreciate the program director Gaurav Gargji, who has kept all the efforts in this series. I'm thankful to Pratibha, Nitinji, Lavish, all the coordinators, my NIRC team, because I should say that it is not my NIRC, that is your NIRC that is performing for you, and we are always for you. तो आप इस सोच के साथ और भी कोई आपके फीडबैक्स सजेशंस हो तो feel free to connect with any of us being a regional council member, and we will surely take care of all the matters and suggestions. Thanking again all of you. Pratibha, handing over to you for formal start for Nitin ji. Pratibha, mute हैं आप.
Okay, thank you, Navya sir, for giving this introduction and giving me back the dais. So now I think our guru, I don't have to say anything else. So our guru is here. I will not take a little more minute. मैं और ज़्यादा वक्त नहीं गवाऊंगी अब. और sir, stage अब आपका है. Now you can take. It's all yours. Over to you, sir.
Well, thank you very much. Before I start, I just want to know, am I audible? Is the volume clear for everyone? Pratibha, if you can confirm.
It's clear, sir.
Yes, sir, it's clearly audible. You are clearly audible.
Perfect. So thank you very much for giving me this opportunity. Lovesh, Pratibha, Navya, I can't thank you much, and in Gaurav in absentia for having this. Before we start, I just want to say that one of the reasons for being regular with NIRC is because the kind of warm welcome they give you, the butterflies in your stomach, and your hands getting cold, they start to, with the welcome, you start to feel warm again. It's the warm at heart attitude by the NIRC which actually promotes people like me to be regular and take up these forums. So thank you very much for that, Navya. I think I could not have spoken about myself with the passion that you have spoken about. So thank you once again for that. Thank you, Navya, for hosting me here. And Luis, I hope the Patiala branch has gets more people, and there are more CAs who want to take up TP after this session. I will count that as a success, than the number of participants who attended. Even if a few of the young CAs take up TP as a profession, and they grow up and take this chair and tomorrow take the session, I believe that is a win for what NIRC wants to achieve. So thank you very much for that. Before I start, I just wanted to introduce two people with me, Minakshi Gupta and Divya Mathur. It would be wrong on my part not to give them the credit straight away, because once we start the presentation and the discussions, you would see the hard work that both of them would have put in. And just in case there is any issues with the system, I will change the system, take either Meenakshi or Divya's system. And, so there could be a disruption for a minute, but otherwise, we expect the session to be, all clear. So with that, we can start the session today. I'll request Meenakshi, if you can just, put up the presentation and share your screen. So thank you. The topic that we have for discussion is key issues in transfer pricing in India. And just wanted to start by saying that the views and the discussion that we are going to do are personal. They may not represent the strategies of, or the views of the firm. This is basis the practical experience that I have gathered over the years. How we're going to plan it out is, we are starting at about 4:15. We plan to take this session up to about 5:45, and we'll leave last 15 minutes for questions. But in case you believe your question is urgent, or you want to put up a comment which has a bearing on the discussion that we are doing there and then, please feel free to interject. Please feel free to put your question there and then. I'll be more than happy, to take your questions. The question that we're going to select in the end would either be on a first come first serve or on a random basis. I don't know how the team will select. But in case there are any questions that are left, I believe you can get in touch with the organization and the organizers, and the questions will come to us. We'll try and resolve as many in the discussion today. So this is the program that we're going to be doing. So if you have the contents page in front of you, we'll start with a background of how and when TP started. We are here to discuss on the key issues. So we have broken down the issues into two aspects: the compliance related issues and the litigation around those issues. And then we will quickly touch upon the controversy management, on what are the options available in case we do not want to go into litigation and we want to look at alternate dispute resolution mechanism. We'll spend a couple of minutes there before we hand it over to the questions. Going towards the background, you would know TP got introduced in India in 2001. That was a time, I don't know if some of you in the session today were even born or not, but that is the time when TP came in. A lot of us, when we were doing RCA, TP was just getting introduced, and we had a fear that, if we get a question from this for which we do not have a practical knowledge, how are we going to tackle that? But when we opened up our book, we realized that the TP regulations that have been promulgated in the law are only 4 or 5 pages. So, the best way to do them was mug them up at the moment, be prepared for the questions, and, just go ahead, take your exams and see later on what happens. So starting my journey from there to now, I think, that is where we stand today. Going forward, in terms of the background for transfer price, so transfer price is the price which is applied or proposed to be applied in a transaction between related parties. There are two sides in a transfer pricing transaction. One is, the entity which is either a service provider or a manufacturer, or the entity which is, giving a service. And on the other side, there is a service recipient, or an entity which is having the goods, which is the receiver of the goods or the services. The beauty is that being cross-border, the impact of TP will immediately hit two countries. So if you try and pull it up from one side, there can be impact on the other side. Hence, the issue in transfer pricing is that there is sometimes a wafer thin margin, or there is, very thin line between managing the controversy on both sides. It can be transactions where you try and increase the margin on one side, you have an issue on the other side. So you need to strike that thin balance. And how do you need to thrive on that thin balance is through transactions which are done on an arm's length basis. Moment we talk about arm's length basis, the arm's length price is a price which is applied or proposed to be applied in a transaction between unrelated parties in uncontrolled transactions. These are important words because the transactions have to be done between unrelated parties, and even the conditions in which they need to do should be uncontrolled. If by any chance the transactions are controlled, then they would not fall under the purview of the arm's length price. In terms of the compliance as we stand today, uh, the the compliance are fourfold. One is Form 3C EB, which is also known as the transfer pricing certificate or the accountant's report. The other is your base document called transfer pricing documentation or the local file, which is also known, by the name after we had the BEPS Action Plan 13 coming in 2017. The third compliance here is in relation to master file, and the fourth is in relation to country by country report. The master file and the country by country report, they are relatively new regulations. They came into the picture in 2017 when the BEPS Action Plan 13 came into force. They are in the full rigor in terms of the compliance, but the controversy or the issues are currently not there in terms of the taxpayers having any issues with the tax authorities. And considering that, in this presentation today, we are just going to concentrate ourselves when it comes to Forms 3CEB and litigation around the transfer pricing documentation. Since there are no controversies currently in terms of master file and country by country report, we will skip the discussion around them. Taking our discussion forward, the general issues under litigation currently, which we will cover in the presentation today, will be in relation to marketing intangibles issue, which is also called the AMP issue or the advertisement issue. The second is in terms of royalty, payment of royalty, which has been under scanner for a long time with the authorities. Then there is issues around management cross charge or intragroup services. The general controversy which has been there for time and again now is in relation to comparables and methods. Then we'll spend some time on the kind of adjustments which are there, why these adjustments are required, and what are the controversies around these adjustments. The other two topics which we picked up here is because they have been in litigation for some time. There have been differences in the approach and how the taxpayers want to take it up and how the authorities want to take it up. So we'll put it in the forum here for the discussion of the people. They relate to contract R&D and they relate to profit attribution. Going towards the key issues in terms of compliance. So first we'll pick up the issues in relation to Form 3CEB. And just to repeat, Form 3CB, also known as the accountant's report or the transfer pricing certificate. So before we go ahead, let's talk more about Form 3CB, what its purpose, what is its applicability, and what are the due dates. The purpose of Form 3CB, it is the first reporting that happens in terms of your international transactions. There are 3 or 4 important aspects about the reporting that happens in this form. The first is the related party with whom you're transacting. The second is the value of the transaction. The third is the method that you have applied, basis which you are either concluding that the transactions are at arm's length or basis which you're concluding that the transactions are not at arm's length, right? And the fourth here is, the accountants certify through this Form 3CB that the taxpayers have maintained prescribed TP documentation. So this is the purpose when it comes to a Form 3CB. In terms of applicability in the law, there is no minimum threshold given for that in terms of international transactions. So even for a transaction of 1 rupee, there is applicability of Form 3CB. There is, however, a threshold given when it comes to specified domestic transactions, whereby it says that if the aggregate value of the transaction exceeds Indian rupees 20 crores in the fiscal year, then there is applicability of Form 3CB and the TP provisions start to kick in. Now, Form 3CB is a machinery provision which says that it is mandatory to file a Form 3CB. This 3CB is only a certificate. This is not a detailed form. This is the first form that goes to the authorities. Transfer pricing documentation is not filed with the authorities. It will be filed only when time comes. So this document becomes the base document. Hence, it is important that it captures the right data. And in terms of the nomenclature, or in terms of the background of the form, uh, the basis of this form is the financial statements of the company. Though there are transactions like deemed international transactions which are not there in the financial statement, but they do form part of Form 3CB. We'll discuss more on deemed international transactions once we talk about the other issues, as you can see on the slide. In terms of the due date, the form needs to be filed 1 month prior to the due date of filing the income tax return. As of now, the due date for filing income tax return is end of November. So for Form 3CB, the due date becomes 31st October. Uh, then there are penalties in relation to a delay in filing as per Section 271BA. On failure to furnish a report in Form 3CB, there's a minimum penalty of Indian rupees 1 lakh, which may be imposed in the case. There is also a penalty in case of incorrect filing or non-reporting of any transaction, which is as per Section 271AA, which says that in case you fail to furnish or maintain information and documentation and fails to report or furnish inaccurate information, penalty of 2% of the value of transaction may be imposed. What we have seen is this section is invoked where there is non-reporting of a transaction in Form 3CB. In terms of other issues, we have seen three major issues which are there in relation to Form 3CB. A lot of time, people believe that this is a no harm form, but considering the penalty involved in terms of non-reporting of a transaction, this form has its own value. It's not a no harm form. It can create issues and implications in case there is either a delay in filing or non-reporting of a transaction. There are a few issues that we have seen more in terms of the form. One is non-filing of form by non-resident entities. This is typical in two cases. The first is where, there we have a branch or a project office in India. And there is a lot of time we receive a query whether a branch or a foreign or a project office needs to file Form 3CB. The answer to that is a clear yes, they need to do that. Second, we have received a query where TDS has already been deducted. My return would be filed as a nil return where there'll be no further payment of taxes. Or in cases where there is an exemption to file the income tax return, do we still need to do Form 3CB? The answer to that again is a yes. There is no embargo. There is no displacement given in law or no special provisions in law that in such cases you do not need to file Form 3CB. Like I said, these are machinery provisions. So machinery provisions start to kick in there and then. And as per machinery provision, if you are required to file, then you are required to file. Otherwise, there are implications in terms of penalty as we discussed above. The second issue which we want to highlight here is there are non-reporting of transactions like free of cost transactions. Now, again, I know there can be some misconceptions that people carry that, you have to file Form 3CB even if there is a rupee of transaction. This is a case where Form 3CB is filed even for not a rupee of a transaction, and this is also as per the guidance note of ICI, which states that free of cost transactions need to be reported. A lot of times we are in discussion with our clients or in general academic discussions where people ask us what is the reason for such a provision in law that you have to report free of cost transactions. I believe one of the reasons here could be, let's take an example that we are a cost plus entity in India, and for provision of our services we are receiving a lot of databases and a lot of support that comes in from the related parties, and they do not charge me for that. Now, the fact is, if they do not charge me for that, my cost base that is being considered is not right. And hence, there can be an allegation tomorrow from the authorities that you have considered an inappropriate cost base, whereas your cost base is not 100% to the cost that has been incurred, whereas you are being compared to comparables who have taken a complete cost base in a third party situation. And definitely if in a third party situation that there are generally no free of cost transactions, except in situations where you're selling samples and all, which is a normal situation, which I believe even if there are provision of any samples of any free of goods which are being supplied to test waters in a jurisdiction, there is no harm in reporting these transactions. So free of cost transactions, again, as per the guidelines issued by ICI, are mandatory to be reported in a Form 3CP. The other thing which where we saw a lot of reporting not happening is non-reporting of deemed international transactions. Now, these are special provisions under Section 92(b)(2) of the Income Tax Act. These are deeming provisions. Moment we say these are deeming, which means that these provisions are not there in any other law. They are supposed, these transactions are deemed to be transactions. So transactions have happened, which may not fall within the purview of the normal definition, but due to deeming section, they become part of the TP transactions. Now, these are not reported anywhere in AS 18. They are not reported anywhere in Section 188 reportings. And these are transactions which are there in your financial statements, but not reported anywhere in financial statements. So first challenge that we see with these transactions is what we call as, how do you identify these transactions? So we are talking about a risk here that how do you identify such transactions? And, there is a clear-cut guidance in Section 92(b)(2). There are clear-cut guidance in the ICA guidelines, guidance note on how these transactions need to be, first need to be identified and then these need to be reported. In case of non-reporting, again, there is a penalty. So we have seen that deemed international transactions are generally not analyzed and not reported, but these are important in terms of coming to Form 3CB. These were certain things in relation to Form 3CB. Going further, let's talk about the main thing here, which is the TP documentation. In terms of TP documentation, the ingredients of the TP documentation are given in Rule 10D. So Rule 10D then acts as a Bible on how and what kind of transactions you need to maintain. In terms of these guidelines, we call them, if any taxpayer needs to maintain TP documentation, then these are the prescribed guidelines which tell you on what should be there in a TP documentation. So there, for the ease of reference, we have divided them into three parts. One is the entity related information which should be there in the TP documentation. That is the profile of the industry, the profile of the group, the profile of the Indian entity, and profile of the associate enterprise, or in short form, we call them in our language as AEs. Apart from that, there needs to be details in relation to the transaction which has happened, which would be, details from the intercompany agreement, the details from the invoices, and the pricing related correspondences such as emails, letter, in case they're not explicitly written in the agreement or invoices, then we need to take that. And the third important is the price related on how the price setting was done between related parties, the transaction terms, the functional analysis or the FAR analysis, which we call in our language for functions, assets, and risks. The economic analysis, which should be the method selection, the comparable benchmarking, and in case required, the forecast, budgets, and estimates in case they have a bearing on the price related. I will just take a pause here and maybe take a step back in terms of the TP documentation. Why I want to take a step back is moment you look at Rule 10D, there is a detailed list given in Rule 10D1, which goes from subsection A to a subsection M in terms of what all needs to be there. A lot of times there is a confusion on what should form part of the local file and what should not form part of the local file. In that case, this um, the components which are given in Rule 10D the idea should be that whatever can be captured as part of the TP report, they should be captured as part of the TP report. For any taxpayer, TP starts with the documentation, your litigation starts with the documentation, your litigation also ends with the documentation. So the closer it is to the prescribed components, the better it would be to support at the time of litigation. Hence, I took a step back to, to tell you that it is always important for each TP documentation that we look at the list from A to M, try and cover as much as we can in the TP documentation. And for the others, we will need to educate our clients. We'll need to educate, people who are on the client side maintaining those documentation to ensure that these are there. In terms of the prescribed limit for TP documentation, there is a misnomer which a lot of people carry that the threshold is Indian rupees 1 crore. The way the law is worded is that in case the value of international transaction exceeds rupees 1 crore, then the company needs to maintain prescribed documentation. For the benefit of the group, I'll read out what Rule 10D2 says. It specifies that every person who has entered into an international transaction or specified domestic transaction, the aggregate value of which exceeds INR 1 crore or 20 crore respectively, it is required to maintain information and documents as prescribed, which states that in case it exceeds, you need to maintain as prescribed. But if it doesn't, still the onus is on the taxpayer to substantiate that the transactions were done on an arm's length basis. Without TP documentation and without having such analysis, issuance of TP certificate in Form 3CB will have its own challenges. Like I said, in TP documentation, the two main parts are the method that has been selected and the conclusion basis the method that the transactions are at arm's length or transactions are not at arm's length, and the certification given by the accountant that company has maintained documentation. Now, if the company does not have documentation, so let's say if the company has transaction value of say 90 lakhs and it does not have documentation, the challenge is how do you say that the transactions have been done in arm's length, and then how do you certify that in the TP document in your TP certificate? Hence, it's a misnomer that we see a lot of time people carry that you need to maintain TP documentation only if the transaction value of 1 crore. It is you need to maintain prescribed TP documentation if the transaction value of the international transaction aggregate value exceeds INR 1 crore, or for specified domestic transaction, it exceeds 20 crores. In terms of timelines, TP documentation needs to be in existence at the time of filing 3CB. Like I said, your TP documentation or your local file is the basis which your TP document, your Form 3CB, the TP certificate is prepared and filed. So if the TP documentation and the analysis contained therein is not there, there'll be challenges in issuance of the TP certificate. I think we can go forward, discussions more on TP documentation. Like we said, this is the lifeline and this is where the litigation starts and the litigation ends. Once it comes to TP documentation, we have seen general issues which we have highlighted here. The first general issue which we want to talk about is incomplete FAR analysis. Time and again, we have seen many documentation where the details in the TP documentation are either incomplete or they are not complete to the respect of forming a judgment. Moment we talk about FAR, it is functional asset and risk analysis. And we have to clearly identify the functions being performed by the transacting entities, the risk which is borne by each of them. How TP works is your functions determine the kind of risk that you bear. With the functions and the risk in hand, you determine what should be the economic remuneration that should be there, and that is where we do the economic analysis. that there is a direct proportion in terms of functions and risk to the economic remuneration that you get. Hence, a detailed and complete FAR analysis is of utmost importance in any TP documentation. Every function that that the entities are doing, it needs to be clearly defined who is doing which role. This again becomes very important once we come to discussions on contract R&Ds, or we come to our discussions around selection of comparables. A lot of times, if the TP documentation is loosely worded in terms of the functions being undertaken, or it is loosely worded in terms of which entity is doing what, where the control supervision is. We've read OECD guidelines where they talk about SPF, that is a significant people function. So we have to see where the SPF is. Now, in case this is not there, what happens is it leads to incorrect capturing of the facts, which leads to incorrect economic analysis, incorrect arm's length price, and incorrect conclusion. Here, it is also important that the FAR analysis being done, there is substance over form, that there is the function analysis which is being written is closer to the ground reality on how and what is happening in a company. In case there is a difference in those, there can be challenges in future. Going forward would be the incomplete best method analysis. Now, let me tell you a bit of background. Till 2010, OECD had given, there were 5 methods and OECD had given a preference. It said that there are 2 kinds of approaches. One are the traditional methods and the second is profit-based methods. The traditional methods were given a preference over the profit-based method. And the hierarchy was, in case traditional methods are not applicable, only then you go for profit-based methods. However, after 2010, this hierarchical approach has been done away with. And even in the Indian TP regulations, the approach is now on best method analysis. So now we have to evaluate each method independently, and each method will have its own importance. So with this best method approach, you're required to analyze each method minutely. If the same is applicable in the case, it needs to be accepted. And in case a method is not applicable in the case, we need to give reasons on why this method is not applicable. So that has to be clearly documented and justified in the report. There can be situations where there are more than one method which is applicable in our case. Let me take an example of a manufacturing company which is selling goods to its related party outside India. So let's say it is selling 10 commodities. For 4 commodities that it is selling, the related party was earlier or still continues to buy from third party as well. So there could be cup method which could be applicable on 4. However, for the other 6, cup method may not be applicable. So in the report for the 4, we'll have to go ahead and say yes, cup is applicable, and we have to analyze cup. And for the balance 6 or 6 and 4 corroborative, we have to go into a different method to justify that the transactions were done on an arm's length basis. So here, since there is no hierarchy and we believe that cup method for these 4 would not be the most appropriate and there could be challenges around it, then we can go and apply only the one method which is applicable to all 10. And that is where we can complete our TP documentation. So the appropriate reasons for rejection and selection of a particular method needs to be there. This also needs to be supported at the time of litigation, which we can discuss in the further slides. Next issue which we want to discuss here is the selection of incorrect method. This is again a challenge, like we said, that there has to be a best method analysis which is there. However, there are cases where we have seen that there's selection of incorrect method. It could be stemming from an incomplete FAR analysis. It could be stemming from an incomplete best method, or both, or a combination of these, which leads to a selection of an incorrect method. Here it is, let me give an example of a trading company. If you look at how the trading companies operate, there are three kind of traders that are there in the market. One is a limited risk distributor. So instead of traders, let me use the word distributors. So there are limited risk distributors whom we also call as LRDs. The second is the risk bearing distributor. And the third is your entrepreneurial distributor. In terms of a limited risk distributor, the decision and the overall guidance support how much stock to keep, what kind of stock to keep, the decision on the kind of products that you will put in the market. It all depends upon the related party, which is the ultimate manufacturer of the goods. So what the Indian entity does is only a limited function of carrying out under the control supervision, the implementation of the group's policy, and that is why they are entitled to a return on the overall cost that they incur. So they are entitled to a net return, which means that the method that needs to be selected in terms of a limited risk distributor is a method where the net profitability can be tested. The second category of a distributor here is a risk-bearing distributor who says, okay, I am entitled to an arm's length gross margin, and after that, it is my responsibility on how I develop the market. It is my responsibility to push a few products in the market. I know my market well and I know what kind of products will sell here. So you give me these kind of, so they pick up the products of the group from the library and say, okay, these are the kind of products that will be there in the Indian market, and this is what we believe we can push. You give me an arm's length gross margin, and it is up to me to make the market and earn a return out of that. So all residual profits in case of a risk-bearing distributor, they remain with the risk-bearing distributor here. So they do not get passed on to the associate enterprise, which is there in case of a limited risk distributor situation. Why I gave this example is because in case you have to first see from your FER, it will come out very clearly whether you are a risk-bearing distributor or you're a limited risk distributor. That is where your FER needs to be comprehensive and not incomplete. That is where when you're doing your best method analysis, do you have reasons for acceptance or rejection of a method? And that is where you have to select the the correct method so that your analysis gives you the right answer. I know a question will be bubbling in your mind. What is the third category of these distributors, which are, super distributors? They are distributors who take care of the market themselves. They are super distributors. They buy the goods from the manufacturers on a cost plus basis. So they say, okay, just just manufacture these kind of goods, and I will take the responsibility of selling them in the market. A lot of these goods are generic goods. They do not require any specialized R&D, and hence, these situations can be taken up. Going further, the other general issue which we want to talk about here is the incorrect application of the selected method. Now, based on the function analysis, it becomes important to select the right comparables. It becomes important that the method is correctly applied, and for every method you need the right comparables. Hence, let's discuss the incorrect application of selected method and the comparable selection together. Or rather, let me give you more examples in case of incorrect application of a selected method. A lot of times, we have seen that where the Indian entity is remunerated on a cost plus basis, the method that people prefer to select is CPM, that is the cost plus method, whereas that is not the correct method. Moment I select a wrong method, then I do an incorrect application of the method. This is also we see when it comes to service companies where, like I said, cost plus method. This is also where we see on how the method has to be applied when the new method was introduced in 2013 under Rule 10AB for other method. I'll discuss these methods in the next slide, so I'm not going too much into them right now. I'll quickly jump on to the comparable selection and the margin analysis issue. Now, like I said, based on the function analysis, it becomes important to select the right set of comparables. Now, let us consider ourselves to say a manufacturer, which is a contract manufacturer, and I'm selling goods to a related party. Now, a lot of times when we do the search, we come up with manufacturers who are full-fledged, and it becomes very difficult for us to decide, okay, what kind of comparables to select and what kind of comparables here manufacturers to reject. There can be a few filters that we can apply, say like an R&D filter. So if I'm a contract manufacturer, I'm not supposed to do R&D. The R&D is done by someone else, and I'm just supposed to manufacture and sell the products. We can apply this as a filter. We can also apply a filter for advertisement and marketing spend. As a contract manufacturer, since I am obliged only to sell to my related party, I should not be incurring any expenses or any excessive expenses in relation to marketing, building of the marketing or advertisement. I can apply these filters and come up to the right comparable selection. This becomes important because if your comparable selection is wrong, then you would see a lot of issues coming your way in terms of litigation. Moment we are done with the selection of comparables, uh, the other important issue comes up on the margin computation on how this should be done. Now, there is no formal regulations for considering an item as operating and non-operating for the computation of margins. However, the only guidance that is there available currently is under the safe harbor provisions. Though the safe harbor provisions are applicable only if you're opting for safe harbor. In case you have not opted for safe harbor, then these are not applicable to you. However, these are the guidance which is currently there, and this is a guidance which we see tax authorities also adopting once they're doing their once they're doing their analysis, once they're doing the audit or the assessment of the case or the scrutiny of our cases, we see them more or less going back to safe harbor and taking a reliance. Now, it is interesting fact in there as well, because some of the items there as well become contentious. Let me give an example of a none. So as per the safe harbors provision, written back needs to be considered as a non-operating income, and any provision being created in the book should be considered as a non-operating expense. There are a lot of provisions which we see on the face of the P&L, and it is easy for us to pick them and say, yes, these are non-operating and as per the guidelines, and take them off. However, there's a lot of provisions which are hidden, say like a provision for gratuity, which will be hidden in your total employee cost. Sometimes you do not see them on the face of P&L. So it becomes a challenge on how do you consider them as non-operating. So there are challenges, there are issues, there are no formal regulations. These have to be taken on a case-to-case basis. But over the years of TP litigation going on, since 2001, the issues have more or less settled, and there is a good guidance available in safe harbor, so we can as of now place reliance and go ahead and take each item on a case-to-case basis. Going further, so this is where actually we conclude for the issues in terms of the compliance. I will also call them that these are issues which we see a lot from the side of a taxpayer than from the side litigation coming in from the side of the department. These are the points which I really wanted to put in, because moment you talk about key issues have to be there on both sides, as a person who's preparing the documentation, and second, as from the perspective of the taxpayer, and what kind of checks and safeguards you need to make. Maybe I'll take a quick pause here and take up a couple of questions here which have come up. I think one of the question which is there is
Yes, so there is a question where it says, when you say there is no threshold prescribed for Form 3EB,
Mhm,
3CEB, does
hmm.
the basic limit of international transaction of 1 crore is also not applicable?
Okay. So uh, when I say it is not prescribed, so that means in case the transaction value, let's take an example, the transaction value is 1 lakh. In that case, you need to do your Form 3CB. You are not required to maintain prescribed documentation, but you are required to maintain documentation to substantiate that the transaction was done on an arm's length basis. So I suppose this answered that question. There is
Okay,
another
thank
question. There's another question here. We can take that too as well.
Yeah, sure, sir. Abhinav Jain has asked a question.
Mhm,
Is regarding the non-resident companies having no permanent establishment in India, which has taken the pan in India
mhm,
due to SEP for online form 10F. Although the transaction will be covered by DTAA,
mhm.
will form 3CEB will be required for such companies where withholding tax is deducted, and if not deducted, one is service sale and one is goods sale.
Okay. So as I understand, where there is services, there would have been withholding done in India as per the DTAA. So I believe where the question is coming from is moment the withholding has been done. So hypothetically, let's say my transaction value was say 2 crore Indian rupees or 10 crore Indian rupees, where a withholding on say a rate of 10% was done, and the balance was paid to the related party. Now, when it comes to the question of TP, the transaction has been done between two related parties. So definitely Form 3CB becomes applicable. The transaction value was more than 1 crore. So even the applicability or the uh, the onus of maintaining prescribed documentation comes into play. Once we are looking at sale of goods, I'm assuming that the sale of goods, the transaction would have happened outside India, where the title transfer would have happened outside India. Hence, from a DTAA perspective, this is not a transaction which has been done in India. So this is a transaction which is outside the purview of TP regulations in India, and hence TP provisions do not get applicable. So for the sale of goods, in case of no P in India and transactions happening outside India not becoming taxable in India due to the DTAA, TP provisions will not get attracted.
Thank you so much, sir. And now, as far there are no more questions, you can just move ahead, sir.
Sure. Thank you very much. Uh, Now let's go to issues which are under litigation. Here again, the ground rule remains the same. That in case there are any questions which are pressing, please feel free to interject. Otherwise, we'll take up these questions after about 45 minutes from now. So comparables and methods. We did discuss about comparables and methods, but looking at how the litigation has panned out around them. Majority of the litigation in India that is there is on these comparables and methods and margin analysis. But before we go ahead, let's look at the selection of most appropriate method as per Rule 10C and Rule 10B1. Why I want to just spend about 10 minutes here is because moment we are right at this case, our litigation would also be right here. So the first method, so we have 6 methods which are there in the regulations as of now. The first is comparable uncontrolled price method, which is generally used in case of royalty and interest, because here what you're doing is you're benchmarking a rate. So moment you're benchmarking a rate, uh, you get, you know, you get into a situation that there is an arm's length price which is directly available. So what you're doing is you get into benchmarking of the transaction, then getting an aggregation or any other approach. In regulations other than India, say in US and all, CUP is also called CUT, which is comparable uncontrolled transaction, because you get into comparison of the transaction. For the benefit of all, I just want to tell you that comparable uncontrolled price method is the method where the applicability is most strict. There are stringent guidelines being given, there are stringent provisions being written on how to look at the comparability. Why that is there is because here you are comparing a price. So you're saying a price of X and a price of Y I want to compare. The challenge is that every product that is being sold in the market has a USP, which is a unique selling proposition. Now, if every product has a USP, it will be very difficult to call them same. And if any of us here are twins, you would realize that even to the outside world, you may look totally the same, but even twins have some differences, basis which you can differentiate between the two. So that is where the challenges around cup comes in. The second is the resale price method. We discussed that resale price method, the applicability here is in case of distributors of goods purchased from related parties or associate enterprise or AEs, and then they are sold to unrelated parties involving little or no value addition. Now, in resale price method, what is tested is the gross margin. So, in moment we are doing any profit-based analysis, you have to do it basis a profit-linked indicator, the PLI. So, the profit-linked indicator in a situation for an RPM, oh sorry, not a profit link, but a profit level indicator. I'm sorry. The profit level indicator or a PLI in case of an RPM is gross margin. Now here, a situation where you're buying goods from a related party outside India and selling into India with no or little value addition, you can apply RPM. But let's look at a situation where you're buying goods from a related party in India and you're selling it to a third party outside India. Now, here the challenge is that this transaction may get under the purview of TP under specified domestic transactions, but you are still prohibited from application of resale price method because it says goods purchased. Uh, sorry. I think I gave a wrong example. The example here is that I am buying from unrelated parties in India and I'm selling to a related party outside India. Now here again, I act as a distributor with little or no value addition. But in this case, I am prohibited by law from application of RPM because it says it's distribution of goods purchased from related parties and sold to unrelated parties. So we see this as a common issue because a lot of companies are now, buying and selling to related parties outside India. We see them applying RPM, but that is not prescribed as per law. Uh, Going ahead with cost plus method or CPM, it is generally applied in case of sale of semi-finished goods to related parties. We have seen a very, very common issue when it comes to a cost plus method. A lot of service companies in India which operate captive service provider, they operate under cost plus basis. So they charge a markup on their entire cost. And many Form 3CBs and TP documentations have come our way where CPM has been written uh, with the misconception that CPM here means cost plus method is what I follow in my accounting. So cost plus method is the method that is applicable in terms of TP. I just wanted to clarify that this is not the correct approach when it comes to TP because the cost plus approach or on markup on total cost basis is your basis of accounting. It is not the basis of your TP. When it comes to TP, in case of the CPM, what is the profit level indicator or your PLI is gross margin, and the PLI is not net. Hence, in a total cost plus, the PLI is net basis, so it should not be applied yet. The other is the profit split method, which is seldom used, but this is the method which is going to gain popularity in times to come. What a profit split method says, or this is normally used, is in situations in multiple international transactions which are closely related or closely interrelated, that they cannot be evaluated separately for determining the ALP, that is the arm's length price. Now, let me just read out a text here, which is important for profit split, and why I want to spend 2 more minutes on this, because I said that this method is going to become important in future. This method has been gaining popularity with the tax authorities as well, though it has not gained a lot of popularity with the taxpayers. but tax authorities are seriously evaluating profit split as a method to be applied. Now, the text I want to read out is as follows. The PSM is normally used in multiple international transactions which are so closely interrelated that they cannot be evaluated separately for determining the ALP. This method would require identification of the combined profits or loss of the A's and to split between them. PSM is normally used in situation where both parties to the control transaction own valuable non-routine intangibles and contribute to international transactions. Now, these words where it says transactions own valuable non-routine assets and contribute to international transactions are gaining importance. Uh, the concept of significant economic presence, the concept of, even in TP, the concept is changing from FAR, that is functional asset and risk, to FARM, that is functional asset, risk and market. So where your users are, where your buyers are, that is also gaining a lot of importance. And moment that importance happens, the words like, you own valuable non-routine intangible assets would start coming into play, and that is why the profit split method would start to gain more popularity. With the new business models which are coming in, let me give you an example of any tech company that that comes to your mind. The two important aspects for the tech companies is technology and the users, right? You think in terms of Netflix, you think in terms of Zomato's, you think in terms of any other company. One is tech platform, the other is your platform where you have the users. So they are of equal importance for this business, the new age business, to become a success. Where it'll be difficult to apply any of the methods which are generally applied in terms of car pre-sale price method, or cost plus method, and that is where profit split is going to gain more importance. Going to the next method, which is transactional net margin method, TNMM as it is popularly called. It is one of the most popular method. It is, and I've written it here, it is the residual method for profit-based analysis because uh, this is most widely used. Majority of the analysis which is done in India is done on the basis of TNMM. This is popularly used in case of provision of services, in case of manufacturing entities. So this is the most widely used. The basic reason why this is widely used is because this method compare normal net profit margin computed in relation to cost incurred or sales affected, asset employed, or having regard to any other relevant base. So one, it allows you the flexibility. Second, TNMM is less affected by transactional differences than in case of price that is there in any price-based method. The net margins which are computed under the PLI for the TNMM, they are more tolerant to functional differences between the controlled and the uncontrolled transactions than the gross profit margin. Third, the differences in functions performed between enterprises are often reflected in various operating expenses. Consequently, the enterprises may have a wide margin of gross margin, but when it comes to net level, it is generally equivalent to how the industry is making. Your gross profit can differ, but ultimately your net profit in that industry comes and in that same region, or the data points are much more closer. So being more tolerant, allowing you more flexibility, this is widely used. Why this is also widely used by the tax authorities, or rather, before I go on, let me just tell you that the joke around TNMM is this method was based on the idiom all's well that ends well. Ant bhala to sab bhala. And that is where even the taxpayer and the tax authorities started using TNMM on a most wide basis. So what is being argued on both sides is, after doing all your transactions, let me see what you are making. If you're making an overall arm's length return, I would leave you, I would say you're good. All your transactions would have been done on an arm's length basis. So here, TNMM takes over all the assumptions, saying that, okay, if all my transactions are done, They are put together, they're evaluated on an aggregated basis. Basis this aggregation, I can substantiate, I can prove that my transactions were done on an arm's length basis. That means all were done on an arm's length basis. This allows flexibility, like I said. So the flexibility is taxpayer doing 10, 15 transactions, one may be up, one may be down on an overall basis. You're doing it different entities, you're doing different transactions with different entities. So all that multiple jargon comes under one roof, which is TNMM. It provides you with a bigger umbrella. It says, okay, you can come take shelter under me. The fact is, all these transactions which are there within me, if the umbrella is big enough, I'll guard all of you. So ant bhala, sab bhala, overall I'm making arm's length return. Good. In tax authorities also happy. Okay, I'm getting good amount of profit. Everything is fine. Now, this may not be the best approach, but this is one of an effective approach. If I can use that word here, it is also one of the most widely used approaches. Uh, Going ahead to other method. It was introduced by CBDT wide notification, which came in 2012, and this has prescribed the other method. Now, other method generally is not there in the OECD guidelines. They have these 5 methods. Sixth is an additional. So we have to thank the tax authorities for giving us this method. Now, it is important to see what the ICAI guidelines talk about the other method in terms of its applicability and in terms of its usage. Let me just read out this for the benefit of the group. So as per para 6.32 of ICAI guidance note of 2013, the sixth method allows the use of any other method which takes into account first, the price which has been charged or paid. Second, would have been charged or paid for same or similar uncontrolled transactions with or between non-associated enterprises under similar circumstances, considering all the relevant factors. So what we see here is the guidance notes state that this method is very close to CUP, but it allows you the flexibility by usage of the words of price, which would have been charged or paid. It also allows you the flexibility under similar circumstances. So relaxing a bit of the stricter comparability criteria which are there under the CUP method. Now, various data which may possibly be used for comparability could be third-party quotations, valuation reports, tender or bid documents, documents relating to negotiations, standard rate cards, commercial and economic business models, etc. So here again, there is a guideline which is there on how it should be done. Why these third-party quotations and valuation reports and everything are there? Because of the usage of the words that it can take a price which would have been charged or paid. So what we are assuming is, if I would have not done a transaction with my related party at the price X, I would have done it at a price X with an unrelated party because of the quotation that I have, or a price Y on the quotation which I have, and I can compare these X and Y, or they fall within the tolerance band of arm's length. But what we come across is other method is being rampantly used for transactions, saying that due to economic circumstances, the transactions are considered to be at arm's length on application of other method, which is where a lot of litigation starts, because this is not what is stated as per the guidelines. It is stated that it has to be done under those specific situations, and again, it has to be applied the way it is prescribed in law. With these 6 methods, the choice of the TP method, it depends upon the specific facts and circumstances of the transaction, including the nature of goods or services being transferred, the level of comparability with third-party transactions, availability of internal data, availability of external and comparable data. Here it is important that the applicability of any TP method must be supported by a thorough analysis. We did talk about acceptance and rejections being clearly documented in the TP documentation. This is where we'll talk about the methods. Let me come to the general issues when it comes to method. CPM versus TNMM. I have actually touched upon this twice. but I'll just, for the benefit of the group, conclude it here saying that CPM versus TNMM, especially in cases where cost plus basis, CPM tests the PLR here is gross margin, so it tests the gross margin. It is preferably applicable in terms of sale of semi-finished goods, whereas TNMM is, the PLR here is net profit, and it tests the overall net profit being done. In terms of services, it is very difficult to say what is part of the gross cost, what is not part of the gross cost. Hence, we do not see CPM being applied in case of services transactions. The second is, RPM versus TNMM. Again, there is too much of litigation around this method where the taxpayers have time and again preferred to apply RPM, where the tax authorities have time and again preferred to apply TNMM. The tax authorities say that I am a risk-bearing distributor, and hence I have applied RPM. Whereas the tax authorities have alleged that no, you are risk-bearing, you're not a risk-bearing distributor, and hence for you, I would not apply TNMM. Here, it is the importance of the entity characterization which will come to your rescue, the internal documentation which should be there, the substance over form, when it comes to the companies into selection of the method. What is my substance over form, what I have written in my TP documentation, how I've defined my FAR, and what is generally there in terms of my internal emails and my internal documentation on how I conduct my business. This is of utmost importance here. Also, like I said, TNMM, Anbhala, Dosabhala, tax authorities is okay, even if you're a distributor, you know, the functions that you may do, the RPM is subject, to stricter comparability. You may be doing some functions, or you may be doing some activities which are directly in relation to sales, and the margin or the GP may not be properly reflected. Hence, I would prefer to apply TNMM, which is more tolerant to functional differences, and there is a lot of litigation around that. Though with the courts, the proposition is fairly settled that where there is little or no value addition to the goods, RPM has been considered as the most appropriate method. But again, uh, this should not be used as the only criteria. A lot of criteria should come up from your FAR analysis. The third general issue which we have seen is the appropriate application of cup method. Now, when it comes to cup method, like I said, there is strict guidelines given in terms of how this should be done, how this should be applied. We have seen many times that cup has been loosely applied, and where there has been a lot of challenges around the application of cup. There have been, case laws which are there in public domain. I don't want to go to case laws here because in TP a lot of things become case specific. But in terms of cup, the major factor or what the crux of the case law is, in case you have internal data, that is much more preferred for application of cup, because there you can easily and very well do the comparability analysis. Wherever we have seen cup being applied with external data, there have been challenges because you may know all the factors, terms and conditions of the transaction from your side, but you may not know the terms and conditions and factors on the external data side. That is where the cup method has its own challenges, it has its own limitations. But that is where the situation is. So if you believe you have the data to support it, please go ahead and apply cup. If there is some challenges in the data, then cup method should generally be avoided. Going further, the issue when it comes to comparables and margins, like I said, the margins issue is perennial. It has been there for time immemorial. Once the TP started, the TP litigation started only with comparables. There are issues in relation to selection of appropriate comparables. There is clear-cut guidelines given in Rule 10B 2 of the income tax rules. So let me just read out for the benefit of the group. So 10B2 lays down the criteria for comparability between international transactions. and uncontrolled transactions. This process is not qualitative, but is not quantitative, but qualitative, and involves an exercise of judgment. So, moment there is an exercise of judgment, there is subjectivity. The criteria that are listed in 10b2 are distinctive nature of property transferred or services provided, functions performed taking into account the assets employed or to be employed, risk assumed by respective parties, contractual terms of the transactions, market conditions. So in effect, function analysis, let's take it in terms of an ITS company. Function analysis in the context of ITS companies involves assessing of functions performed, risk assumed, the assets employed. But what we have seen time and again is wide comparables being taken at the time of TP documentation and wide comparables being taken at the time of audit being concluded by the authorities as well. There are comparables like Tata, they're comparable like Tata companies like TCS, they're companies like Infosys and Wipro, which find their way into the comparable set, and there is a skewness around the final outcome of the ALP. Yes, this is a challenge. There are a lot of judgments now around that with support on their non-selection. But what I would suggest is before we go ahead and put an allegation on the authorities, we need to make our own TP documentation more robust so that we are able to defend ourselves in those situations once we come to that. Uh, I don't want to spend too much of time on the comparables. I think we've already done that enough discussion. Let's go to the next one on the selection of foreign entity as a tested party. Again, this issue has been there in contention for a long time, and uh, the general factor is here as once we go back to our regulations, we would see that uh, there are no prescriptions or there is no embargo that you have to only take the Indian entity as the tested party. The tested party should normally be the party which is least complex to the transactions being done. There is availability of most reliable data of tested party and requirement of minimal adjustments in which is one of the most important criterias when it comes to selection of a tested party. Like I said, there is no bar for the tested party being local or foreign, which is there in the Act or any TP guidelines. And there are many situations where data relates to the related party gives you a much reliable result. Let me give you another example. Here is in terms of intragroup services. So let's say an Indian entity is having a revenue of 100. It is having a cost of, let's say, 90. It has the intergroup services of say 1 and 9 is the profit. Or let me put it this way. Let the intergroup services be 8 and let 2 be the profit. Now, a lot of people, a lot of companies, and a lot of times tax authorities, they prefer to test this too and say after the payment of the intergroup services, you are making a return which is not as per the industry standard, which is not as per ALP. The comparables are making 7 or 8, you are just making 2. Hence, this transaction is not at arm's length. However, if you look at it in your full P&L of 100, the value of related party transaction was 8. That is only 8% of the value of your transaction. It is not recommended to put your full P&L under risk here. And even if you look at the transaction, once I avail these services for my internal consumption, I am the complex entity because I take these for my internal consumption and I do my full operations. Whereas the related party is just supposed to provide me with a small set of services and be out of the way how I am conducting my business. So if I look at the factors on which is the least complex, it'll become the related party. If I look at the factor on where uh, minimal adjustments would be required, which will be the related party because it'll be just billing me on a cost plus basis. So I have the reliable results of the related party. I have the margins with me. I can easily find the comparables. International databases are no secrets to anyone now, and everybody has access to them. And that is where the selection of tested party of a foreign entity would allow you not to put your full P&L at risk. It will also allow you to do the analysis which is there based on correct TP guidelines. in today's age and time, you also need to be aware of the fact that the group has master files and all which are being prepared. You have to check for alignment of your TP documentation with master files. And moment you're doing that in the master file of the group, they would have written that, okay, foreign entities are least complex entities providing services. And that is where the TP testing is being done. And we have a total different analysis which will be there in either a TP documentation or a TP order, which will then be contrary to how the group operates. The last point is multiple year data versus single year data. No, this discussion was more or less settled in 2015 when the law was amended to include multiple year data for analysis of the comparables. However, there is no such provision to take multiple year data for the tested party. This discussion became heated up in the last few years, especially post-COVID and the COVID years. Why? Because for the comparables, there was multiple year data being taken, and for the tested party, the year that was taken was single year. So if my single year is affected by COVID, and for the comparables, if I take the 3 year data where only 1 year would be affected by COVID and two would be normal, it's a no-brainer that margins of the comparables would be higher. So, this issue has been there time immemorial. Nobody has argued too much around this because even after this, transactions have been found to be at arm's length due to some, either issue on comparables or an issue on method. But this discussion was not heated up, after the initial rounds. But this would again come into fore now with the COVID years happening. Uh, this is where we'll conclude, at least for the comparables and the margins. Uh, Taking forward, we would be discussing a lot on the comparability adjustments. The comparability adjustments, the discussion is given in Rule 10b(1) and 10b(3). So they talk about an adjustment made to the conditions of uncontrolled transaction with a view of eliminating the effects of material differences between them and the control transaction being examined. Now, Rule 10b(3) says reasonably accurate adjustment to eliminate material differences. Now, the wordplay here is on two words, which is reasonably accurate. Now, we are talking about, time where even differences of a few points or a few decimal points can say transaction at arm's length and transaction not at arm's length. So how do we decipher between the words reasonably accurate? Over the years, what I have learned is that these two words should be read separately. Reasonably is to be applied in terms of the approach, and accurate is to be applied in terms of the arithmetical accuracy. So when you are doing an adjustment, your approach has to be reasonable, but your computation has to be accurate. And that is why you will fit into this definition of a reasonably accurate adjustment to eliminate material differences. So you'll have to actually read it reverse. So first there have to be material differences, which you need to eliminate. For that, you need to do an adjustment, which should be accurate so that you get the desired results or you get the right results. And the approach that you follow here should be reasonable. So if you try and read it in reverse, it'll make more sense for you. Now, as per the ICI guidelines, the common adjustments are working capital adjustment, risk adjustment, idle capacity or startup cost adjustment, and you have a depreciation adjustment. Of these four, working capital adjustment, which seeks to adjust the differences in the time value of money employed in working capital cycle between the tested party and the comparables. This is the most widely used and most widely applied adjustment. This has been accepted by courts in the past. This actually fits into the definition of reasonably accurate adjustment to eliminate material differences. So the money that is being blocked in the working capital, which has an impact on the profitability, is adjusted here. The data is available from the annual reports. So the data that you get is accurate. The adjustment that you can do is accurate. And what you get as a desired result is a working capital adjustment, so that whatever money has been blocked in terms of the capital being employed, you are adjusted to that. This also takes care of another aspect is we see a lot of litigation around outstanding receivables. There has been case law of Kusum Healthcare in the past by the Delhi High Court, which has said that in case working capital adjustment has been done, then no separate adjustment on account of outstanding receivables can, should be done, because we have already factored the impact in the pricing and profitability. Second adjustment, which we commonly see and also prescribed by the ICAI guidelines, are the capacity adjustment. Now, capacity adjustment relates to differences in utilization of capacity, which has a direct bearing on the margins of profitability and affects the arm's length profit. Now, these are situations where a company may be working on a lower capacity, which could be because it's a startup. It could be because it has idle capacity due to an XYZ reasons. Now that XYZ reasons in a lot of cases is COVID, it is easier to close down a factory, switch is there, close it, but it is not that easy to just switch on, put that switch to on and say, my machinery is now working on a full capacity. The assembly lines and other things which are there, it takes us time uh, for the machinery to be started and to get back to the same capacity. And why this got a lot more importance is, if you look at the P&L of any company, uh, there are two kinds of costs that we get in there. The first cost that we get in there is my variable cost. The second kind of cost that I get here is the fixed cost. Now, variable cost is associated directly with how the sales happen, right? So the cost which may directly vary because of production level is my variable cost. But the fixed costs remain same irrespective of the level of operations. They have a direct bearing on the profit, because moment anybody starts any operations, the first thing is, these are my fixed costs. Even, as a salaried person who's done a lot of investment, the first thing we look at is, okay, this is my fixed cost. All others are variable, which I can manage or which will be there as proportion to the income that I get. So once these fixed costs are incurred, which have a bearing on the capacity, which will get absorbed as and when the capacity increases, and that is where there is the requirement for the capacity adjustment that came into being. Now, there are many judgments in court where this has been accepted, and there are many judgments where there are differences on why work on capacity should not be given. These are case specific, but where the biggest challenge which has come in over the years is, earlier in the financial statements, the data in relation to capacity, the utilize and the total capacity was there. Now the data is not there. So the challenge now with capacity adjustment is you do not have data exactly of the selected companies, which do not allow you to do an accurate adjustment. So your adjustment is reasonable here, desired, but is it accurate? The answer could be a no, until unless you have that kind of data, and that is where a lot of challenges around capacity adjustment we see now in today's age and time. There are others in terms of risk adjustment, adjustment for low risk in captive service providers. Again, here there's a misnomer which a lot of people used to carry, that if I am a captive service provider, I am a no risk company. In my personal opinion, there is nothing called no risk. Anything that we do, there is a risk involved. So it will be wrong to say that they are no risk, but it will be correct to say that they are low risk, because they are working under controlled supervision. They are paid for the rework. So here the risk is that is there with them is low, and that is why a lot of adjustments is being asked for. Is once you're doing the comparable analysis, you realize that you are not able to find companies which are into a low risk model. You find only full-fledged companies, full-fledged service providers, and you want to take some adjustments. Now here the challenge is again on computation, because it is not accurate. It is a dipstick analysis which you say this risk factor has this much of an impact. I am not able to do it, with a complete accuracy. There are a few case laws where this has been allowed on an ad hoc basis, but this may not be the best approach here. The other is the depreciation adjustment. Depreciation adjustment is generally there in case of new companies where have just started their operations, and we see that even when they start the operation, the fixed assets that are being utilized are new, or even in terms of companies which has got new assets, we see that the depreciation cost in them is very high vis-a-vis the depreciation on the third parties is low. And the clear factor to that is the new fixed assets, so the new plant and machinery. So there is a depreciation adjustment that can be done if we want to eliminate the material differences. The other way around for this is we change the PLI from operating profit to cash PLI. So what we say is, instead of saying operating profit by operating cost, we say operating profit minus plus depreciation divided by total cost minus depreciation. So what come to that is, we come to the approach which is um, I would say a total cash basis. So I look at the approach on a total cash profit basis and say, had depreciation been equal or had depreciation which is materially impact, if I take that out of the picture, then what I am left with is the correct picture to be shown to the authorities. And this is where my transactions are at arm's length. So it is not because I have bought some raw material or have done a transaction or I have sold them to them at a price which is affected. It is only because my plant and machinery was new, where my transactions are totally with unrelated parties, which has impacted my profitability, and hence the difference in the ALP. That is where we'll stop on the comparability adjustment. We'll now go to the marketing intangibles issue. Now, this is uh, the most significant and the most unresolved challenges currently in the transfer pricing litigation. This is called marketing intangibles issue. This is also called the AMP issue. This is also called the advertisement issue. I believe this is one of those issues which is very frivolously and furiously litigated on both sides. Why I say frivolously on some sides is because uh, there is an approach called Bright Line, which started, which got stuck down, but which is still being used. Why I call them to be done very ferociously from both sides, because both sides have taken it to the Supreme Court. The matter is pending with the Supreme Court. It has very wide ramifications, very wide, vast effect on not one but two, but virtually all industries together, all kind of traders, virtually all kind of manufacturing companies are affected by it. So this is a big litigation where both sides have lockdowns, and both sides are not ready to give an inch to anybody. And it will be a big judgment once it comes from the Supreme Court. As a background, the initial consideration of this issue arose actually in a US tax court, which was in the case of DHL, primarily due to a 1968 US regulation introducing the concept of developer assister rule. Now, under this rule, the developer, despite not being the legal owner of the brand, was deemed the economic owner of the brand if they incurred AMP expenditure. So let me tell you about these two concepts. And this will also cover once we are doing royalty. Is there is a concept in OECD BEPS action plan which is on DEMPE, DEMPE, which is development, enhancement, maintenance, protection, and exploitation. In terms of this, there is a legal owner of an intangible who says, okay, I own the technology and I own the brand. I am ready to give you this technology, I'm ready to give you this brand for a royalty. So I will charge you a royalty for the right to use, because I have spent considerable amount of time and energy into developing that. Now, when it comes to a developer assister rule, why I want to reiterate again that despite not being the legal owner of the brand, the developer, the sorry, under the rules, the developer not rather the developer was the legal owner of the brand. The assister, who was not the legal owner of the brand, was deemed to be the economic owner because it incurred a lot of expenditure and it kept the benefit to itself. So the question was, who owns the supernormal profit that comes out of the effort which the assister did? Now, one school of thought said, okay, there is an expenditure that you incurred. Now, why did you incur so much of expenses? So the company said, I incur these expenses because they are impacting my sales. If I incur a lot of advertisement expenses, if I incur a lot of sales promotion expenses, they increase my sales. The tax authority said, you want to incur these expenses on products, on brands which you do not own. So why do you want to incur something that you do not own? Has someone told you to incur these expenses? If you have been told to incur these expenses and you're working under control, supervision, and guidance, then this is a service that you're being provided. And the service is that because of the effort that you're putting in, there is an enhancement in the value of the brand. So this is where you should be entitled to a return. Now, how this case got importance is actually a judgment which was in the case of Maruti Suzuki Limited. It is, I think, a 2010 judgment where uh, the case at the beginning was that Maruti Suzuki in India was there in the manufacturing of vehicles, which is of which everybody knows. So it used to use two brands, Maruti and Suzuki, and the the allegation from the tax authorities was that the brand Suzuki is piggybacking on the brand Maruti. So people who would know the brand Maruti would know the brand Suzuki. Now, because you're incurring so much of expenses under the garb of Maruti, you're actually giving a lot of benefit to Suzuki because you're building a brand. So the challenge was, is a brand Suzuki being built under the garb of Maruti? That is where the allegation was. And it said that Suzuki had piggybacked on the brand value and promotion of the brand Maruti in India. The Delhi High Court overturned the finding, and it held that whenever there is such an arrangement, the Indian related party is not required to be compensated by the foreign related party if the expenses incurred do not exceed the expenses made by comparable entities which are independent, similar situations by the Indian companies. The ALP price of the comparable entities must be calculated using the bright line test. And if such expenses are more than what an independent, similarly situated comparable entity would make, then the foreign entity must compensate the Indian entity to the related party as the brand of the foreign entity benefited from the expenses incurred by the Indian entity. So what happened is Delhi High Court reverted the issue back to the tax authorities for re-examination. The case from Suzuki side went up to Supreme Court. Supreme Court, while again agreed to remanded the case back to the tax officer, it directed him not to take into account the guidelines issued by High Court, and they should follow the provisions in law in order to compute the appropriate taxable income. But what happened is, even though the case got remanded back and Supreme Court said do not use the directions what is given by or the guidelines given by High Court, these guidelines became guidelines for how the tax authorities wanted to approach on the issue. And this gave birth to the bright line test. Up till then, bright line was used in what we are seeing today. The dance of democracy is what how Tao says, and how um, we got introduced that today is the day when the elections start. So bright line was used as a test to say, okay, you're over 18, you can vote. You're under 18, you cannot vote. And how this bright line got promulgated into the bright line test approach for marketing intangible issue, it says, okay, if you are incurring expenses more than what the comparables are, then you're doing brand building. If you are incurring less, then you're not doing brand building. So the question was on the bright line test, The question was whether is it an international transaction where there should be an arm's length remuneration. Now, going going ahead in this case, there was the special bench which was formed in Delhi ITAT, and this was the case of 2013 in case of LG, where they said that whatever is happening is whatever the allegation from the authorities is there is right. The tribunal upheld the approach of bright line test by the TPO in order to determine the arm's length price. And they said, okay, if their expenses are excessive, then there is an international transaction. Then this matter traveled to High Court, where the lead judgment was in the case of Sony Ericsson. I think it was a 2015 judgment which came out from High Court, which overturned the decision of the special bench on many counts. In crux, what it said is as follows. The court categorically rejected the bright line test, stating that applying a test would lead to unforeseen tax implications and complications, and that a test is not stipulated anywhere in the Income Tax Act. It is beyond the scope of Chapter 10 and income tax rules, and hence cannot be used to determine excessive expenditure. Hence, the existing of an international transaction was not disputed, but there were different tests being laid down on how this is to be done. And the other question where it came up to, it said, okay, you know, there are so many cases, there are so many interjectors with there, but this is a case which is this is an issue which is case specific. So if this is case specific, we don't want to paint everybody with the same brush. And that is where the case, a lot of cases got remanded to ITAT on the normal benches, and there were different judgments being coming out. Now, in 2016, Maruti Suzuki case went again to the Supreme Court, and the judgment here was saying that court agreed that the contentions of the company was right. It held that existence of an international transaction has to be proved, and it cannot be simply assumed via a backward calculation of bright line. So again, it said that it is a transaction or not. It cannot be said only basis where it cannot be said only because the expenses being incurred are excessive. It has to be said in cases where you have factual evidence or material on record to substantiate that this is happening. Where it stands now, so there is a change which has come in, a retrospective amendment which has been brought in the Finance Act in 2012, where AMP expenses and these kind of transactions have been put under the purview of international transactions. However, the matter is still pending with the Supreme Court, and everybody is watching them with with eagerness to see what the court decides. It will have ramifications for everyone, so everyone's in keeping their fingers crossed on what the judgment would be. However, once we are dealing on these issues on a practical front, we also see that there is incorrect AMP computation, there is incorrect application of profit split method now being put. And why there is a lot of importance on profit split is because it said intangibles and method said intangibles on both sides. However, what is being forgotten here is that the Indian entity is again being termed as a support service provider. So the application of PSM would need intangibles coming in from the Indian side also, which has not been alleged by the authorities. So there is an incorrect application of PSM on this transaction. But currently litigation is going on, so I don't want to state too much on the incorrect approaches and the incorrect application. Going forward, we'll touch upon the next topic, which is the royalty. We did discuss on royalty a bit. So again, before I go ahead into royalty, let me just give you a small example here. Let's say a company has a revenue of 100. We know the royalty that the company pays generally is from 3 to 5%. So let's hypothetically assume the royalty being paid is 4. Uh, let's say the expenses are 90 and let's say my profit is 6. A lot of times we are tempted to say, okay, 6 by 100 is where my PLI, so I'm making a 6% profit. let me find comparables and see what kind of margin they are making. And I say, okay, I am at 6, comparables are at 5. So the royalty that I'm paying is at arm's length. That is one approach where we try and do aggregate analysis as we have written in the challenges. It is an aggregate analysis. However, uh, the challenge is we are putting the full P&L at risk here, which is, your 100 of the value, where your your value of the international transaction is only 4%. And if you look at this case, the profit that you got of 6 is not only impacted by the royalty that you paid of 4, but also impacted by the expenses of 90 that you incurred. If in if today you're fine, but tomorrow there can be increase on this 90, which will be transactions done with unrelated parties, not have a bearing on the international transaction, nothing of that sort. But still, you can end up making losses, or you can end up making 2% margin. There, this challenge of applying a backdoor entry through a TNMM may not serve you the right purpose. So here the aggregate analysis, saying that okay, I aggregate all the transaction and I say I'm at arm's length, may not be the best approach. So that is where we suggest that we do a, a segregate approach where we test the transaction on a singular basis, so on a standalone basis. Through the application of cup or cut, we try and find comparables. There are challenges in finding comparables because a lot of times these intangibles are unique, and we see that the transactions or the comparable transactions that we find for them are only in relation to how the wager other groups are operating. So they're not uncontrolled transactions. So there are challenges in finding the data, but over the years we have seen that we have find a way around in finding the analysis. We have come up with the right answers. In terms of strategies, it is always good to have a robust TP documentation. We see tax authorities challenging, saying that there is no benefit that has come your way. So conducting a DEMPI analysis to see, to tell them, okay, where the development happened, where the enhancement happened, who is giving you protection, who is doing maintenance, and how you're doing the exploitation would help you overcome that challenge. There can be backup documentation in terms of how the technology has come in, what are your brand guidelines, what are the guidelines of the group, how the instructions come to you, which will help you support that, okay, I got the right to use and this is how I got the right to use. In terms of approach, dual approach is something that is now being preferred. So the rate benchmarking of 3 or 4% and corroborated by saying that, okay, even after payment of royalty, I'm making an arm's length return. Anbhala, sabhala, everybody is happy. I'm making an arm's length return. Good enough. Everybody is happy in that situation. Management cross-charge. This is an issue which, or intra-group services, this is an issue which is perennially under litigation. Primary reason being, the authorities have put this issue under a test. And the test that they say is, before you go ahead and do any kind of analysis on the ANP determination, first let it pass the litmus test of need test. That means the Indian entity has to substantiate that there was a need. A lot of times the allegation is that you're a full-fledged operation. Why do you need these services? The second is the services test. Okay, I agree you needed them. Tell me who provided, what are their qualification, how they provided. Third is the benefit test. What benefit did you get from these services? Now, there are judgments which say that a TPO is not supposed to get into this, and you're not supposed to do any benefit analysis, and this is commercial expediency. However, this is still going on. And after that, the challenge is you have to substantiate that none of the services being provided was shareholder duplication, and there was no incidental benefit that was happening. So this is the challenge, or these are the issues which they put in front of you. The answer to that is the company need to have robust TP documentation to substantiate these tests, backup documentation to substantiate emails, call details, some reports, some presentations to substantiate the need test, services test, and the benefit test. After you cross those hurdles, you come to the test of computation, which is how these were determined to the cross charge. So how do you derive at this value? Did it have a direct charge, which is people providing you with the service? 10 people providing, what was the salary, how much got allocated to you, how it got allocated to you, and why the allocation key was used. Indirect charge, okay, what are these indirect expenses? So, definitely if a person is sitting in office, there are going to be incidental expenses around that, indirect expenses. So how they were loaded to the direct cost, what kind of allocation was done, how many group entities. So you have to overcome that. And the last is the markup. If any charge by the related party, you have to substantiate the markup was at arm's length. So this has been an issue on, considering that all these issues and all these tests, this has been a lot under litigation. We have seen this litigation into a lot of shape and form where a lot of the times these are the cases which get remanded back, and people have to go back and start with their backup documentation. So heads up, please maintain your documentation. And we have seen also a case where it was an Indian entity for which the TPO said that services are not being rendered. Incidentally, our foreign entity was also getting, was also under audit, where it was said, okay, services are being provided. So we were able to produce that document to the ITAT and said one says doc service is not provided, the other says service is provided, and we were able to overcome that challenge. But still, even in that hearing, the court did ask us for some backup documentation. So this is how it getting utmost important. Where I want to touch upon is another issue is layering of services. So let's take an example of an Indian entity, a group having a headquarter in the US, a regional headquarter in say Singapore, and a regional entity in India. Now, yeah, though the regional headquarter that is there in Singapore is there to provide services to India as a regional hub, but it may be availing some services from US or any other group entities to provide to India, or it may be provide taking these services from a third party. A lot of time the challenge comes is, do I charge a markup on my total cost, or do I charge a markup on only my cost? In this, the as per the OECD guidelines, markup should be charged only on the cost incurred by the related party. Any third party cost or any cost which is coming in from a related party where markup has already been charged, no additional markup should be charged. So once we're looking at the intragroup services, we need to be careful of the fact of how much layering has happened and how much margin has been charged overall in case double margin has been charged by related parties. Uh, going further is the contract R&D. Now, this issue is more towards factual and looking at substance over form. There's services that are being provided, especially by R&D centers. The services are alleged to be high value added services and sophisticated services. They are alleged to be leading to generation of valuable and unique intellectual property. We see a lot of patents being filed in the US where patents have the name of the Indian entities. So the tax authorities allege that the R&D centers, become the economic owners of the intellectual property that is being transferred without an adequate compensation. And basis that, for when it comes to the ALP determination, the routine and low cost markup does not reflect the arm's length result. Now let's come to see the situation that is there in India. There was a circular 6 was issued earlier. Circular 2 and 3 were issued, which were taken back by the government, and then a circular 2 was issued in 2013. Now this it actually provides guidance specified in relation to R&D centers under 3 categories: entrepreneurial in nature, cost sharing arrangement, and contract R&D on the basis of functional analysis. Here, what it said that the guidelines for identifying a developing center as R&D provider with insignificant risk stated that the same principles will be considered for selection of most appropriate method. That means it put the onus back on the taxpayer to say, give me substance over form. Tell me how you do transactions. Your FAR, how solid is your FAR to substantiate how the remuneration should be, and that is where we'll decide on the most appropriate method. Now, the India chapter in the UN transfer pricing model, country chapter is as against the formal contract of the R&D model, it says that Indian researchers carry out significant functions, and they should be entitled for a remuneration more than that. But Indian authorities have softened the stand. Even in safe harbors today, there is R&D for pharma, there is R&D for software development R&D, where cost plus has been agreed. So I believe where this litigation has led to is how your substance is there, how your form is there, what kind of documentation you have, and how much is your internal documentation or backup documentation supporting your TP documentation. But this is a point of contention because in today's age and time, a lot of R&D centers are now being opened in India. And there is a lot of litigation around this when it comes to the arm's length remuneration. Uh, going further, profit attribution. Now, moment we talk about profit attribution, we have seen time and memorial that, and there was a question also of do we have a P in India? What happens after you have a P in India? How do you decide? There have been cases which say that if transactions have already been done in arms, then there should be no further attribution. But the approach here should be that, whenever there is uh, an entity or a P being allocated, it is assumed that the services being performed in India are more than what, are they prescribed in the agreement or more than what it should be, or there is a fixed place where P where or an agency P where services are happening which should not have, where the arms and remuneration either is not paid, or services are happening on the Indian soil where there is no remuneration or no taxes being paid in India for the economic functions happening. Now, we have seen formulatory approach where courts have said, okay, 10% of the profit, 50% of the profit. But over the years, there has been on profit attribution, there has been a general discussion on FAR based approach. Even though, the Indian authorities did come up with guidelines in the past, which was more towards a formulatory approach than the FAR based approach. But what the OECD suggests is consider profit attribution to be like a normal TP documentation of a normal taxpayer in India, and then do the analysis. So it is not, even if it's it's an allegation or there is um, a presence of an artificial person, it should be considered as a normal person, and only then the analysis should be. So they have talked about analysis being done on a FAR basis. Pratibha, I'll just need 2 more minutes before I complete. I know
No,
we
no issues, no issues.
okay. So this is where I just wanted to conclude on the issues, and I will take a minute more in terms of going towards the controversy management. Uh, Currently, in terms of alternate dispute resolution mechanism, there are three options or alternatives given in the law. One is safe harbor. The rules are already prescribed. There are a lot of transactions under safe harbor. The already agreed pre-percentage is being written on how the what kind of markup you need to earn and how these markups should be computed. And taxpayers are free to adopt safe harbor. You'll need to apply and become an eligible assessee for safe harbors. Second is the APA. I don't think APA need to spend a lot more time. It's not a secret anymore on how APA has been and how successful APA has been into resolving a lot of disputes. The third is MAP, which was not very commonly used in the past, but this is a very effective mechanism to ensure that there is no double taxation in the group. Why this was not very popular in the past is because the Indian entities, rather the Indian government said, in case there is Article 9(2) is not there in the treaty, which allows you for corresponding benefit, we will not do MAP with that country. Now, in 2017, they clarified the position and they said, okay, even if there is no Article 292 there in the treaty, we would still go ahead and we'll accept your MAP applications and go ahead with your MAP procedures. Post that in 2020, they have come up with Rule 44H and 44G, to actually promulgate a lot of rules around MAP on their resolution and how the process would run. So MAP in future will be very popular along with profit split method. And moment you have profit split method, you would see a lot of MAP being correspondingly getting similar kind of popularity. This is where I think I will end my speaking portion for the time being. I will leave it to Lovish and Pratibha to guide me through in case there are any questions. Otherwise, we'll go ahead to conclude the session for the day.
Thank you so much, sir. And I think as far as we are at a situation, there are no more questions. There were just two questions. I think GP is a topic where even we have to think, even if we want to frame a question.
No, I think
So,
I
and
was standing between everybody and their weekend. So now I'll free all of them up.
that can be a reason. So okay, so there is, I think, yeah, one question has come up. Please discuss a bit upon shifting from FAR to FAM.
Okay.
FAM is functions analysis and market.
So I'll take, if you allow me, I'll just answer this. So the the discussion here is that, one is FAR, that is functional assets and risk, and now we are moving towards function assets, risk, and market. Why market has gained importance is because, after the significant economic presence rules also coming into play, where the market is, where your buyers are, they are of equal importance. So, you may be looking at this from the perspective of each country wanting to ensure that moment the companies are coming here and making profits from my land, am I entitled to a share of their profit which has been earned from my land? So, that is where the jurisdictional boundaries and cross border comes into play. We say, okay, you're coming and doing functions here, you're coming and doing some activities here. Are there any economic functions which happen here which have a bearing on the profit? If yes, then it is of significant importance to me, similar to the functions, normal functions being performed here. So that is why it will go and gain importance. And new age business models are very different, and they have to be tackled differently.
Yeah, so there is one more question. If you can answer it very casually,
Sure.
what would be a broader reason or factors when one would advise their clients to go for an APA, that is, I think, Advanced Pricing
Yeah.
Arrangement, or MAP?
So APAs, if you have past litigations, and you want to close that, there are any complex transactions, or you're taking a complex transaction forward, or you're doing any complex business where you believe you can have challenges, then APA is a good option, which will give you a certainty for 5 years forward and 4 years back, so 9-year resolution. And in case there is litigation that has already happened in your case, then MAP is a good option because it allows you to ensure that there is no double taxation. So there is no economic double taxation for the group. So APA is more forward-looking. MAP is more like a post-mortem. Okay, my adjustment has happened. Now, what are the course of options available with me? Uh, and MAPA does allow you to have, litigation and MEP going parallelly. So it allows you an alternate remedy with a normal remedy.
Okay, so that's I think a good explanation, and you have made us understood well. So I think regarding this TP, though when during my articleship period, I this was the topic from which I used to run away. But the way the simple or the comprehensively you have made us understood, and I think now it's looks very easy. You have covered the reporting requirements and the TP documentation, litigation. So a lot of aspects you have covered well. Thank you, and thank you to your team. Minakshi ma'am is there, Divya Mathu ma'am is there. Thank you to the entire team that they put in effort. So being such a responsible position, still you took out the time. So in the end, I'll just request Sanjeev ji from NIRC to present a token of appreciation to you, sir.
Thank you very much, ma'am. I am honored to receive anything that comes my way from NIRC.
Yeah, sir. So, our humbleness. So your humbleness. That's okay. So I'll request to token of appreciation for our chairman, sir, who is present here, who was there as a coordinator. Thank you. This is for you, sir.
Thank you so much. Thank you for giving me this opportunity to be with you guys. And thanks again to Nitinji for an enlightening session for the day. Thank you.
Okay, so now I would like to present a certificate. Our today's moderator, madam, C. Pratibha Singh Rathod ji. Kindly accept it, ma'am. This is for you, behalf of NRC of
Thank you.
ICI.
Okay, thank you so much, sir. So in the end, I will just like to thank our chairman for starting and coming up with such great initiatives, which gives us a way through which, sitting at our home, sitting at our offices, we can just get knowledge and we can remain updated. And thank you to the program director who might not be present here because they might be doing some seminars somewhere else or the webinar somewhere else. But thanks to them that they came up with this So with this third episode, the online bootcamp on international taxation comes on an end. And I want to thank even the NIRC technical team so that this session has happened so smoothly. In the end, looking forward for more such initiatives. Stay connected with us. Thank you all. Thank you, sir. Thank you, Lovish ji. Thank you, Divya ma'am, and thank you, NIRC.
Thank you, everyone.